Good morning, everybody, and very warm welcome to you all. We have a jam-packed hour for you today, talking all you need to know about transfer pricing by our expert speakers from Regan Van Roy. Just a bit of housekeeping before we get going. Please use the Q&A button at the bottom of your screen if you'd like to ask a question throughout the webinar, and use the chat button to report any technical issues you might be having, and one of our members of staff will be able to help you. There will be a 10-minute at the end for Q&A, but please keep your questions coming throughout the webinar, and we will make sure that if we don't answer them at the webinar, we will be following up after the webinar with the answers to your questions. We will also be sharing the slides with you, and this webinar is being recorded, so the recording will also be shared with you afterwards. So without further ado, I'd like to welcome Cabrini McCarrick, lead transfer pricing partner at Regan Van Roy. There you go.
Thanks, Anastasia, and good morning, everyone. We have a big topic to cover today, all you need to know about transfer pricing in Ireland. So we will kick off, but I wanted to welcome everybody and hope you're all doing well this morning. Okay, so what will we be covering today? Our agenda. We'll give an introduction to the team and talk a bit about the global transfer pricing trends. We'll then give an overview on the specific Irish transfer pricing rules and the documentation requirements. Jeff will then talk about controversy management, and I will sum up with some of the wider considerations and next steps. So who are we? Regan Van Roy is a boutique international tax and transfer pricing firm established back in 2016 with offices in South Africa, Mauritius, Portugal, and of course, Ireland. I'm Cabrini McCarrick. I'm from Dublin, originally born and bred in Lucan on a strawberry farm there. Some of you might remember picking your own strawberries there, and moved on to transfer pricing. I qualified as a lawyer in Ireland, then went to London where I did my chartered accountancy exams and really got into transfer pricing there. I was tasked to go over to Johannesburg with the new legislation that was brought in across Africa, and worked there with tax authorities and clients alike. And now I'm back in the Irish market, a lot of it around COVID prompting that move, and currently heading up the Regan Van Roy transfer pricing team here. Great to have Jeff Morris here with us, who's over 20 years of transfer pricing controversy experience with the Australian Tax Authority, the Big Four, and also as a competent authority. Jeff has successfully negotiated advanced pricing agreements and MAP with countries across the globe. And we're lucky to have him in terms of his deep insight into the inner workings of the tax authorities. Stephen Castello is also here with us, over 20 years of transfer pricing experience, 8 of which where he was based in Ireland with the Big Four, namely PwC and KPMG. Stephen's got a keen interest in all things financial services and complex economic analysis, and has advised clients across a range of wide-ranging industries. So we're going to start with what is transfer pricing. We've all heard talk about it. It's becoming more and more a hot topic. With the increased internationalization of business and the complexity of multinational groups, heightened scrutiny of the tax authorities over intergroup transaction has made TP one of the most critical and unfortunately controversial areas in tax and international business. You will all have heard about the base erosion and profit shifting project and all of the work that the OECD has been doing over the last number of years. Essentially, what this has brought about is a new wave of transfer pricing legislation across the globe, and of course here in Ireland. Essentially, the world is demanding tax transparency, and the business world is evolving at such a pace, and now tax law is finally catching up. We always say that TP is the cornerstone of international tax, and that is because TP models are integral to where and how profits are realized within an international group structure. TP, of course, is essentially a tug of war between tax authorities, and double tax is the key risk. because each tax authority is trying to essentially get its fair share of the tax base. The key focus of transfer pricing is on cross-border transactions between connected or associated persons, and whether or not these transactions are arm's length. We'll talk also about the Irish domestic transaction rules a little bit later. But essentially with transfer pricing, profit should follow value creation. And the complexity, of course, is determining how and where that value is created in the supply chain. The onus is on the taxpayer to prove that its related party transactions are arm's length. And this again is when we talk about transfer pricing documentation, this is the format we're tasked to do this in. It can be shown through documentation, the financial data, the legal agreements, and through functional and economic analysis, which is a core component of transfer pricing documentation. And Stephen will take you through that in a bit more detail. But globally and indeed in Ireland, the focus is on economic substance over legal form, and getting into the middle of it and saying, does conduct actually match the legalities that are in place? Also, key focus on the significant people function, who's doing what within the business, and who has the ability to control and manage associated risks. Why does all of this matter? It's because the fact pattern and the economic realities underpins what amounts to an arm's length remuneration in a group context. So put very simply, we're looking at who does what within the group, what's the economic significance in the value chain of what they do, and thereafter, how much should they get paid or what profit they should earn. And that's really what we talk about in a nutshell on transfer pricing. TP is governed by the OECD guidelines, and Ireland is broadly aligned to the OECD guidelines as it tries to, enhance its reputation as a strong-standing tax system. Local Irish rules must also be considered, as there are some anomalies. So what does that mean? If you're relying on group transfer pricing documentation, that will no longer suffice. You need to have your Irish documentation in place that, of course, is aligned with your group, but also considers local law and local specific requirements. Who cares about TP? Is it just me and the likes of us? No, lots of people. Tax authorities and the global regulatory bodies have got a keen focus on transfer pricing. Taxpayers, any business with an international presence needs to be thinking about transfer pricing. And honestly, it goes beyond the tax function to the C-suite, because it's not really like a normal tax. We're looking at economic realities, the business model, commercial fact pattern to substantiate arm's length prices. So everybody cares. Your stakeholders, of course, are interested in what you're interested in and what they're interested in, and the public. There's a lot of reputational considerations around transfer pricing and base erosion and profit shifting. And the risks, for example, are different between a low tax jurisdiction and a high tax jurisdiction. And when it comes to controversy, Jeff will talk a little bit about that in the context of the Irish tax model. An important thing is that transfer pricing is not just about compliance and risk management, which is good news, not totally boring. There's also business model optimization opportunities here. The big difference is that we can't just do it on paper like we did before. The belts and braces framework is critical to ensuring that you've got a robust business model and that is aligned to a robust transfer pricing model as well. In terms of some of the key global trends that we're seeing, there's both from an external perspective, what we're seeing is new legislation popping up everywhere. You'll have seen it in Ireland. We've seen the tax authorities responding to this by upskilling themselves and increasing their audit focus on transfer pricing. Essentially, they're following the money, particularly in the COVID environment when tax authorities are under more pressure to bulk up their revenue. They're seeing transfer pricing as a very sensible way to do this. What we have is increased focus on tax transparency generally. Everybody wants to know what you're doing from a tax perspective and that you're a good boy or a good girl in terms of tax compliance. We have as a result of this, we've got the country by country reporting, master file and local file transfer pricing requirements, and basically massive information sharing between tax authorities that we had not envisioned before. This, of course, leads to TP disputes and a keen political interest. Internally, what does this mean for our business? Annoyingly, of course, it's an increase in the compliance obligations and burden. But more than that, it's rethinking how we do business to ensure we're aligned with best global practices and local and international law. When we look at the alignment of our business models, we need to make sure that it is actually aligned with the TP model. And that's why there's such a heavy focus on the value chain of a group. Who's doing what value does it make, and what are the key functions that actually drive revenue or profit in the context of your holistic business. TP theory is a bit of the past. We used to have our TP document stuck in the cupboard gathering dust. Now we actually have to ensure it's implemented, and we have to have the evidence or the paperwork to back it up to the tax authority. The other thing about when we think of transfer pricing documentation is don't just think about it as compliance. It is actually your core narrative to the tax authority on how you do business. So the content of it, you should be happy. You should be very happy that it actually aligns with your business model, and think of it as your first line of defense, and support from a transfer pricing perspective. Of course, documentation is just the face of it. We also have all the data that's behind it that needs to be tied in. So your financials talk about your transfer pricing transactions. Your tax returns have disclosures on transfer pricing. You've got legal agreements that underpin your transfer pricing policies, as well as how you actually do business on the ground. So it's quite far ranging in terms of, how can you be tested or checked for transfer pricing? There's lots of different forms of information that need to start speaking to each other more coherently. Along those lines, implementation and monitoring is key, and internal processes and procedures are required to be in place to ensure that you, for example, identify what transactions have a TP impact and flag to the business where key considerations or the tax team needs to get involved, for example, to make sure that that what you're doing is going to be supportable in the long term. Some of the key global trends and low-hanging fruit, as we call it, what are the tax authorities looking at? What's everybody crying about? IP and intangibles is critical. There's been a huge focus on this. So we can't just legally own IP somewhere. We have to look at economic substance. And a lot of you will be familiar with what we call DEMFI. It's how is IP developed, enhanced, maintained, protected, and exploited? Why do we care? Because remuneration is attributable to key intangibles in the group. And you have to look at who's economically doing these activities as opposed to legally, because profit will follow such activity. Financial transactions, and again, the OECD have released guidance around this, a huge focus area in Ireland and for the tax authorities. One simple aspect, or who knows if it's simple or not, is but the quantum of your loans. Can you substantiate the conditions and terms of your loans? It's not just about is the interest rate is arm's length. It is the holistic arrangement arm's length. Substance also a key consideration when we think about transfer pricing. What does substance mean? It's not the definition of regulatory substance. Transfer pricing looks at economic substance. So that is people, including significant people functions. It is risks and decision-making and where they're taking place. That's a key focus area in Ireland, which would be a lower tax jurisdiction, to ensure that the appropriate substance is in place and the right people are making the right decision to support their underlying business model and transfer pricing model. There's also an obvious focus of tax authorities on loss-making entities or where there's massive profit fluctuations, because we need to explain that in our documentation and to tax authorities. A lot of focus on procurement hubs, because often there's quite a bit of excess or residual profits retained in procurement hubs. Are they economically viable? Do they have appropriate transfer pricing support? Back-to-back transactions are also being kind of unlocked. Is it a hybrid transactions? What's economically the fact pattern as opposed to what's underpinning that structure? High value transactions. Why do we go after high value transactions? They're just worth more money to tax authorities. And if your core business is largely made up of related party transactions, of course, there'll be a keen focus on your TP. Restructuring and M&A activities, when you have a change in the business model, that is also always going to trigger a change or an alignment of your TP model. So we need to be conscious of that. And from an Irish industry perspective, we look at technology, pharma, IP, and financial services, and the recent impacts of Brexit. We're naturally having a change in how we do business. And if that is in the context of an international group business, that's going to have immediate transfer pricing considerations. Essentially, if you've no documentation, the onus is on the taxpayer to defend their position. So without documentation, your defense position is, pretty tough. Just to talk on some very basic concepts. One is the arm's length principle. And all of transfer pricing relates to this. It's an internationally accepted standard which states where conditions are made or imposed between two enterprises in their commercial or financial relations, which differ from those that would be made between independent parties, then any profits which would, but for these conditions, have not so accrued, may be included in the profits of that enterprise and taxed accordingly. So put simply, we're talking about if the right profit doesn't sit in the right jurisdiction, an adjustment can be made to that tax base. So we're talking about potential for double tax. And essentially and quite simply, we're saying, if you operate within a group, you need to prove that you're operating as if a third party would be. And now you need to go ahead and prove this in your transfer pricing documentation and backing support. In terms of associated person, it's a very, very wide range, but you generally know yourself if you're associated, but it relates to the concept of management control or capital. The key types of transactions that you should be thinking about in your businesses are any type of services transactions, whether you pay for it or not, between a related party, goods, financial transactions, IP and intangible transactions, and capital and asset transactions. Stephen's going to talk a bit more about the specific types of transactions that are really quite key in the context of the Irish market. And then quickly, just in terms of the transfer pricing life cycle, transfer pricing is not just your documentation. It starts off with planning and policy design and figuring out what exactly is in place. You then have to document and benchmark. And then the last part is the dispute resolution and controversy management that you essentially hope to avoid by making sure your policies are correct and your documentations are correct. But what is the often forgotten part is operational TP. That's the in-business's job to monitor what's happening, ensuring that your documentation is not something sitting on a shelf, but it's actually been implemented and monitored in your business so that you've got a good, robust framework in place. So that is essentially an overview of transfer pricing. And now just to really dig into the Irish specific rules, which I'm sure you're all interested in, I'm going to hand over to my colleague, Stephen, to talk you through that.
Hi there. Good morning, everybody. Stephen Castillo. Happy to be here with you this morning to walk you through the Irish transfer pricing rules that have been recently implemented. So we'll start with some interesting news regarding the tax framework in Ireland, and also with respect to transfer pricing. I'll leave it a few seconds for you to check. These are random headers from Irish and international newspapers, where you can see that Ireland is in the eye of the storm when it comes to transfer pricing. Okay. And there are like some interesting comments, like even from Joe Biden talking about tax havens. So there are some news here. They were randomly chosen, so you can Google them, and they are recent enough from recent days. This New York Times talking about Ireland, and the Irish Times, and the International Tax Review talking about like a Facebook controversy also. So so Ireland, in order to align with the international transfer pricing framework, Ireland has been working towards transparency in its legislation. We already, Cabrini already walked us through the transfer pricing basic rules based on the OECD principles. We talk about the arm's length principle, which is the basis of all the transfer pricing practice. And Ireland, in order to align with the international transfer pricing and international tax legislation, has been adhering to slowly, but along the past years, to all these principles, and sometimes partially, sometimes fully endorsing them. So we can see that Ireland has been have adopted the OECD guidelines, of course, as an OECD member. There is an adoption also of the application of the hard to value intangibles, also with respect to the guidance on the application of the transactional profit split methods. Ireland is a country that has around 73 tax treaties with other jurisdictions. It's an interesting number of tax treaties that are actually following the standards of the 2017 OECD guidelines. The OECD has also released further guidance that has been followed by Ireland, and at least partially, with respect to financial transactions. So we're going to talk about those during this presentation. Okay, this is a really ambitious, and I'm sorry there is too much information in this slide, but in this slide, I wanted to comprise all the basic topics that have been recently implemented in Ireland. So it's the adoption. We already talked about the adoption of the OECD guidelines. There are new guidelines issued this January, which will need to be in the future endorsed by the tax authorities in Ireland also, and including the local legislation. There are principles that Cabrini already mentioned. I don't want to overlap them, but there are principles in terms of the substance that over form, where Irish specific provisions require that in cases where the substance is not consistent with the form, which is the legal agreements in place, for example, the transactions can be recharacterized. And this is like something new to the relatively new to the Irish transfer pricing rules. There are also typical documentation requirements in Ireland aligned with Action 13. So there's like 3-tier documentation required in Ireland, including a master file, a local file, and a CBCR report, and its corresponding notification in Ireland. There is now an extension of the transfer pricing rules with respect to non-trading transactions, with the exception of some domestic non-trading transactions. There are also rules with respect to the disposal of certain assets. When you dispose an asset with market value in excess of 25 million euros, is also something that it's covered by the transfer pricing rules in Ireland. Small and medium companies did not require any transfer pricing documentation in the past, but now at least for, medium companies will require certain level of transfer pricing documentation. It's where it's called a simplified transfer pricing documentation. There is also an explicit, and this is based on the coffee report that that was issued a while ago in Ireland, with respect to the removal of legacy grandfathering provisions. Okay, with respect to intercompany agreements, executed before 2010, July 2010. There are also financial transactions rules with respect to, which were mentioned also by Cabrini, with respect to the quantum of the debt, which is, I would call it a quasi debt capacity analysis proposed by the OECD. It's not an interest coverage analysis like exactly like the OECD, but it's like Ireland is moving towards that direction. And also the application of the authorized OECD approach for branches. And there was a question about it, and if transfer pricing documentation was required. Yes, transfer pricing documentation is required for branches in Ireland. Okay, we're going to talk a little bit. We have one slide about that also. So in a nutshell, there are documentation obligations in Ireland, and to start with, the three-tier approach that I mentioned, we have master file obligations, which is group documentation that we're going to see in detail at the later stage. It's a 200 million euros threshold in global revenue for companies that will require to prepare a master file. Companies with a turnover over 50 million will require a local file, while few Irish multinationals will also require the presentation of a CBCR and its corresponding notification when their consolidated group revenue is above 750 million euros. So those are this is what I'm calling the three-tier the documentation approach that has been fully adopted by the Irish transfer pricing rules. Okay, in the previous year, Ireland only adopted the one tier, which was the CBCR requirement. Something important, and this is really helpful for all the taxpayers in Ireland. When should the transfer pricing documentation be available. And it's established already by revenue that the documentation should be prepared at the time the term of the transaction is agreed. So that means when you buy or sell or provide a service or receive a service, you should already on the spot be preparing documentation and have an idea of why that price has been agreed, and you should have evidences that has been agreed at arm's length. In any case, documentation should exist by the time the tax returns falls to be made. So when you file your tax return, of, for example, last year, for companies that have a fiscal year ended in 31 December 2021, you should have the transfer pricing documentation no later than the September 23rd. Remember that in Ireland, there's the domestic transactions are caught by the transfer pricing legislation, and with exception of some non-trading domestic transactions. Okay, this is applicable since this year. With respect to the authorized OECD approach, this has been in place, has been released by the OECD a few years ago already, and this approach applies what is called the separate entity principle, which is some sort of also it's aligned also with the arm's length principle. So you have a branch, and you have in the question that someone posted a few minutes ago with respect to branches. If you have a branch of a UK entity, a UK corporation, you have a branch in Ireland, you will need to treat them as separate entities, as if there is one entity for transfer pricing purposes only in Ireland, and one entity in the UK, where you assign capital and resources to the Irish entity as if it's separate, complete separate company. Okay, I know that I mean the lawyers may think no, it's not a company. Well, it's not an entity, but for transfer pricing purposes, you have to use that concept in your analysis. Okay. And there is a document that the transfer pricing rules adhere, which is called the attribution of profits to permanent establishments that need to be followed when performing this kind of analysis. Okay, with respect to the small and medium companies requirements, there are requirements especially for medium companies, and they have been already defined by the rules, by the Irish transfer pricing rules, and medium companies require a simplified transfer pricing documentation. Okay, which is not necessarily a local file or a master file, because they don't comply with some of the requirements, but in cases where the agreements are above, the intercompany agreements are above 1 million, they will need to prepare some transfer pricing documentation, which we will see what we're talking about. So this is like challenging for medium companies, which will be obliged to maintain transfer pricing documentation. There is an obvious potential increase of transactions, intercompany transactions, that could be challenged by revenue. And this may imply potential adjustments of profits and the taxable base, of course. There's an increased risk for medium companies with different types of activities, either trading or non-trading. Okay. What type of documentation requirements are considered like a part of this simplified requirement in Ireland for medium companies, medium-sized companies? A description of the business need to be included in that documentation. A copy of all relevant legal agreements. That's an easy one. A description, and this is the most probably technical, challenging one. A description of the transfer pricing method used and the reason why the method was selected, along with evidence to support the price selected as being an arm's length amount. So this is basically implies like a method selection, which need to be based on some sort of function analysis and a benchmarking. The amount of consideration payable, receivable under the arrangement, and a description of the functions performed, etc. So it's not a local file, but it has the core elements of a local file, like I can tell you. Okay, so an overview of the Irish transfer pricing rules. We know that Ireland transfer pricing legislation, it's set out in Part 35A of the Taxes Consolidation Act. Ireland transfer pricing legislation applies the arm's length principle, and if there is like a takeaway from all this session is that we should always remember it's this, the arm's length principle. All the analysis and all any challenge that you will see anywhere in the world is respect to the arm's length principle, and if the arm's length principle has been respected in that particular transaction. As I said, Ireland explicitly adheres to the 2017 OECD guidelines, not yet to the 22 OECD guidelines, which are no different from the 2017 in terms of the core principles, but they are like, of course, like some things that were ironed out in the recent version. We already talked about when two people are considered associated in Ireland, which is completely aligned with the OECD principles. And the Irish transfer pricing rules apply to trading transactions, non-trading transactions, capital allowances, and chargeable gains. Okay. Since we are in a session of all you need to know about transfer pricing, we wanted to also to have like talk about a couple minutes about the transfer pricing methods. And there are at this point in time where we could have like 10 sessions, and we probably wouldn't finish to talk about the transfer pricing methods. But basically, you have different methods, and different methods can be applied depending on your facts and circumstances. If you have like you have the comparable control method, which is a comparison of actual prices, but since the world is not perfect and information is not perfect, We also, the transfer pricing practice decided to also use other methods which are based on, can be classified in transactional method, which are the or traditional methods, which is the cap, the cost plus, and resale price, and they are based on either the price or gross profits analysis, and each method can be, except the cap method, can be linked to a financial ratio. And then you have the transactional profit method, which is the TNMM and the profit split. Okay. In practice, the transactional net margin method here on the right hand side is the most used by transparency practitioners in the world. Talking about master file requirements broadly, it's a really, there is a explicit list included in the OECD guidelines. Here we are just capturing the main items, but remember that this is applicable for companies with global revenue above 200 million. So even if your company in Ireland has a 1 million revenue, you will still need to prepare this documentation or have it handy in case of a requirement, revenue requirement. So you will need to have a master file. Typically contains an overview of the group's global operation, details on the intangibles, organizational structure of the group, intercompany financial activities, financial and tax positions, as well as a description of the business itself. While, and this is like, you can see that this is a group documentation, while the local file is specific to the local entity, in this case, an Irish entity. So typically this is applicable for companies with a revenue of 50 million or above. Okay. Well, an overview of the business in Ireland needs to be included, the assets and risk borne. I mean, it's basically a function analysis needs to be included, functions performed, a list of intragroup transactions with the details, quantum, and nature of them. Same transfer pricing methods and comparability analysis, it's required. Transfer pricing policies in place in their application. And what is critical and is technically challenging for most of our clients is a requirement of that a segmented analysis needs to be performed, meaning on a transaction by transaction basis. If you have like services, you have buy goods, and if you sell goods, those are three different transactions. So it's on a transaction by transaction basis, and also key is that the transfer pricing policies needs to be contrasted against the annual accounts, so statutory accounts. Okay, and just finalizing here, there is also CBCR requirements. Also in Ireland, there is like a limited number of multinationals that will require this. Remember that in Ireland, you need to submit documentation. The tax agent will, or the company will need to submit notification of regarding which entity will be submitting the CBCR and where it's going to be submitting that CBCR. And it's like basically, I'm attaching just for completion some details of the kind of information required by the CBCR, which is a country by country report in Ireland. Okay, remember, just to finalize that in Ireland, there is a penalty regime. Okay, and you normally will have 30 days to provide transfer pricing documentation after it has been required by revenue. Failure to submit required documentation will attract penalties of up to 25,000 euros and for greater or larger business, and 4,000 for smaller businesses with revenues below 50 million. What is one of the toughest, probably the toughest penalty that I've seen around the world with respect to CBCRs is the Irish one, which implies well, 19,000 euros penalty plus 2,500 euros penalty for each day the CBCR hasn't been lodged. Okay, so these are like basically in a nutshell what's going on in with respect to transfer pricing in Ireland, and can continue with Jeff.
Oh, thank you very much. Given the time is getting on, I think I'll just go to the key points here. We'll start my video. I think given time is getting away from us, I'll just start my key points. If we go on to the next slide, Stephen, that'd be good. And, you know, Gabrini has mentioned, you know, dramatic increase in TP disputes in Ireland and globally. My explanation for that is BEPS itself. You know, before BEPS came along, it was high tax countries, you know, trying to retrieve revenue from countries that had low tax rates. So, you know, the headlines that Stephen put up about the IRS and Google, Facebook, and Apple, and so on make a lot of sense, you know, from their fiscal perspective. And, you know, after BEPS, you know, we had action items 8 to 10. We had new chapters in the OECD guidelines. You know, we had the OECD and the United Nations build or help countries build capacity for countries to implement transfer pricing rules. We had lots of legislation change, and Ireland is, you know, an expression of that. They've got new rules around implementing the arm's length principle. They've adopted the new OECD guidance. They've strengthened the documentation requirements, and they're accommodating, you know, the country by country reporting and the master file, local file. But I would say, you know, it's kind of tried to say documentation is the first line of defense. And, you know, from my perspective, you know, doing controversy for 20 years, you know, it's really important to get that your business explanation of what you've done, you know, written down. You know, not only is it a legal requirement, you want to actually avoid the penalties, but, you know, it's a contemporaneous explanation of why the pricing makes sense to your business at the time. And it's, you know, it's not just a bland TP analysis for some key transactions. It actually memorializes, you know, all the commercial considerations that went into, you know, why you did the things that you did, why you bought some services that you then paid for with a corporate head office charge, why you bought the goods that you then distributed, why you purchased IP, you know, with an arrangement for a royalties, and so on. It also means that you explain why the contract has the terms that it does, and why that makes business sense. And you can actually line up both the substance of the arrangement with the contractual form. And without, you know, documentation, you know, and this is some things that I used to kind of, you know, trade secret here, do a little bit. When a company didn't have documentation, it really gave, you know, the fiscal, you know, and I was part of this, you know, great leeway to say whatever they liked, because there was no documentation, there was no facts on the ground that could contradict what their argument might be. And some fiscals, you know, are kind of renowned for having their initial order position as as pretty extreme, and they might negotiate some of that down to a more reasonable outcome. But it's all fueled by, a lack of explanation, a lack of facts, and a lack of evidence, and a lack of documentation. Now I recognise, let's move over to the next slide, perhaps. Some of the key trends, Cabrini's mentioned, loss-making enterprises, service fees, where the cost base doesn't align up with actual services provided, IP transfers, substance of those transactions, and all of those, and part of the kind of focus from a fiscal might be, they're trying to build their skills as well. They've now got a lot of transparency over what the taxpayers in their revenue base have done. They can see, the global picture more readily about where their profits are lodged. So there's lots of transparency around where the money is. And whilst they're building the skills, they can use audits and reviews of taxpayers' TP arrangements, both as a kind of a learning exercise. And, let me tell you the number of times that I've seen, dumb TP questions from auditors who don't know much about transfer pricing. It feels like the taxpayer or the client is actually teaching the fiscal how to do their job. But the skills then have to be built in a way, within the client, within the taxpayer, well ahead of where the tax authority is, so that they actually can see the risks, and they can create their documentation to manage those risks appropriately. So when there's, a dispute can come down to audits, and obviously audits are sometimes preceded by some kind of information request, some kind of risk assessment by the fiscal, and you might get some early heads up about what that audit might look like, and how much is it going to cost, what are the risk exposures, what might the adjustment be in a worst case scenario, how are they going to manage the information requests, and so on. And I guess in the broader view, there's, in a way, a distributor being a loss maker in a jurisdiction is a perennial concern of, for example, every tax jurisdiction, and they'll always have perennial concerns about IP transfers, cost of loans, the cost of services that they perform, the transfer pricing implications of a restructure. So all of these things will be kind of rattling around the minds of the fiscal, trying to get a handle on what is it they should put their audit resources to, and how they might manage that process. So in terms of the dispute resolution mechanisms, let's go to the next slide, Stephen. We've got on the slide there APAs and MAPs, mutual agreement procedures, but before that there comes two other options. One is to weather the storm of the audit and try and negotiate an audit outcome that's reasonable, and then once that's decided, you'll then make a request for a mutual agreement procedure to avoid double tax. But the other way to avoid, firstly, and also to manage disputes is through an APA, whether that's a unilateral APA or a bilateral. And it's a familiar process to me, to work with taxpayers and clients who are in the middle of an audit, can see a audit position paper coming or it's just arrived, and can see the cost that it might be to them to manage the dispute. And the APA might be one way in which to separate the past from the go forward years. And one might have a dispute about how the law is applied in the past. So audits become not just a TP transfer pricing dispute, about how the transfer pricing guidelines are applied, but they become a dispute also about how the local law is applied and the words that are used in the black letter of the law. But an APA might actually help separate the past dispute and get some certainty on the treatment going forward. And that could create some efficiencies around, not just managing the dispute anymore, you're actually managing it and getting a better outcome overall. The APAs, though, require a process. You'll have to work with the fiscal about what the requirements of an APA application might look like, whether it's advantageous to have a bilateral APA or a APA amongst 3 or even more countries. And I've done one with a 4-party APA, which was quite the beast, let me tell you. And from the MAP perspective, there are specific rules that the tax fiscals require about how a MAP request can be made by one and the other jurisdiction. But it's important to remember, though, that in the MAP process, there's not an obligation on the fiscals to agree to relieve double tax. It is simply a procedure to share information with the objective of getting an outcome that's acceptable to both, so that the tax levy is in accordance with the treaty between the 2 countries. So some countries have different perspectives on what a MAP case might look like. It's important to understand and follow those local rules. So I think that's a bit of a rush, me getting through that, but maybe I'll hand back to Brandy.
Thanks, Jeff. Thanks, Stephen. Very tight on time. So Stephen, if you could just bring me to the second last slide, and I'll do an effort to sum it up. It's hard not to mention Pillar 1 and Pillar 2. I think the key thing is that with all the changes, it's important to note that TP is underpinning all of these. So when it comes to digital tax, we'll be utilizing transfer pricing principles to determine what is an arm's length profit to market jurisdictions. So that's all on its way, but very linked to what's happening in transfer pricing anyway, just expanding its reaches a bit further. Next slide, please, Stephen. Of course, you'll all be wondering about the global minimum tax. That's going to be key in Ireland, coming about in 2023. It's very much interlinked with transfer pricing to some extent, because there's likely going to be some reconsideration of existing value chains. When we rethink the business model, we automatically have to rethink the transfer pricing model and make sure that it's aligned and robust for a go forward position. Again, you could talk for hours about Pillar 1 and Pillar 2, but it's linked to transfer pricing in kind of a fundamental way. And then finally, just to wrap up, Stephen, on the next slide. Well, COVID-19, I am going to skip these slides, but basically the impact of COVID-19 has been such that a new different type of transaction has arisen between groups because of their need for additional funding. Contractual arrangements have changed and shifted, and we now have to explain a different type of financial results locally. So all of this adds an extra layer of complexity that we need to include in our documentation, basically to strip out the COVID impact and say we would be arm's length, but for the effect of COVID, and strip it out and document it. What it means is really thick files covering the COVID period. So another annoying little trait of COVID. Stephen, you can skip, please, to the next slide, the wrap up. This is probably important. What do you need to do next? So lots of new rules. You need to identify what you've got in place from a transfer pricing perspective. What transactions, what policies? Do you have group documentation you can leverage? Do you have something local? Then you need to determine if what you have is appropriate. Is the transfer pricing supportable, in line, and going to be okay with all the new legislation? If not, what are the gaps and what are the pitfalls? We then need to design a TP strategy to manage the risks and ensure robust and compliant transfer pricing framework is in place. And of course, this includes the necessary transfer pricing documentation and legal agreements. Then we need to implement and monitor what we're doing. Certainly, TP is getting bigger and uglier and requiring much more investment. There's lots to do for September and indeed on an annual basis to make sure that your transfer pricing is up to speed. And I guess, what can we do to help? So at Regan Van Roy, we offer the full suite of transfer pricing services, whether you're starting from scratch, whether you've got a model that needs to be optimized, of course, basic documentation and benchmarks, and indeed the part you want to avoid, controversy management. So as I mentioned, lots to do. It has been really a pleasure to be here. I'm very sorry we didn't get to all the questions. The slides will be shared and you can contact us directly with any questions that you have. We would like to thank the Chartered Accountants Ireland and Jeff and Stephen for being with us today, and all of you for taking the hour out of your lives to think all about transfer pricing. So thank you, everyone, and we hope to hear from a lot of you soon.
Thank you so much, Cabrini, Jeff, and Stephen, for today's really insightful session. As Cabrini mentioned, we will be sharing the slides, the recording with you, and all the contact details as well. So if your question hasn't been answered today, we will make sure that it will get answered after the webinar. Thank you once again to all our speakers and all of you for joining us today. Bye-bye.
Thank you so much.